Volatility continues to abound in these marketplaces. It goes up, it goes down. Your statement values rise and they fall, and it gives us all sorts of questions. Deep desires to understand what this really means for our future, for our country, for our grandkids. The Financial Enhancement Group does not have all the answers, but what they do have is a plan to help you emotionally, responsibly deal with what we know to be certain, the economic situation we're in. The fiduciaries at the Financial Enhancement Group can help lay out for you a plan that you can follow that doesn't react to news, doesn't react to volatility, but rather responds in a pre-described discipline to how to deal with changes in the tax code, changes in the economy, and certainly fluctuations within the market. Give us a call at 800-928-4001 or go to yourlifeafterwork.com. Get signed up for your Next Steps meeting. It's complimentary. 800-928-4001, yourlifeafterwork.com. Good morning and welcome back to your Retirement Playbook. I'm your host, Joe Clark, and we're talking about a case today. A couple that came in to see me had some very, very important questions, and I've tried to take this whole show from a very basic conversation through an advanced conversation in primarily three different areas. We looked at inflation, volatility, and now we're going to talk about the legacy plan. It all goes under your Retirement Playbook. And James Clear is not a friend of mine. I've read his books, Atomic Habits. I think he's a great communicator, if you will. But this quotation just resonates with me because it's so true on the golf course. I think it's true with our faith. I know it's true with the tax code, and it's certainly true with financial planning. And that's that success is never dependent upon one thing, but failure can be. And when I taught at Purdue, I broke down for the students what I called the 5 critical elements. First of all, you had to know where it was you were going. You're on a financial journey. You did not save and accumulate for 40 years to have a 1-year wonder or a 1-week wonder or a 1-month wonder, right? You wanted a financial journey that was going to last as long as you were here with us. So you've got to know where it is you want to go. Otherwise, as they say, any road may get you there. There are 5 other areas, though. Your life after work, how you deal with separating from the workforce, and what you're going to do with your time and your energy and your attention and your money are different than when you had an employer that you went to, even if it was yourself. The annual tax plan, how you're going to treat the IRS's strategy. And yes, they do have a strategy to extract revenue from the taxpayer to be able to do things that some of us deem important, others seem wasteful. Regardless, that is their strategy. How do we fairly, properly impose tax liability? And believe me, everybody on both sides of the aisle think what they're trying to do is fair for all concerned. Nobody's going to agree with that, but that's what they all believe to be true. So I look at tax planning as a strategy. What do I want to do this year that gets you on the best track for your entire financial journey? Gives you the most options to navigate the changes the IRS may bring into play. The third is the investment playbook. How do I deal with the surprises that occur, like Ukraine, the Pelosi visiting Taiwan, the COVID virus? How do I deal with the market volatility, the response to those very same issues? 2 different things, economic and that. The investment playbook. How do I deal with that? How do I remove reaction and replace with it responsiveness that's disciplined, that's already predetermined, if you will? Fourth is life happens. When I get caught with an emotional thing, a challenge in my life that I have not seen before, what do I do? Because right now the answer for most people is to go to WebMD to find out about the health crisis or to go to Google to try to find somebody that's talked about it. Our blessing and curse, if you will, at the Financial Enhancement Group, we've taken care of more than 2,000 families over the years, about 1,100 now that we take care of currently. We get to deal with the sad stuff every day and the good stuff every day. And we're checklist nuts. So we've built checklists to try to help people navigate those issues. But the last and not least is the legacy plan, and it's really what got me into the industry. This is what I became so enthralled with. 1984, I watched, and actually I should go back before that because it really happened when my grandfather passed away. And I don't know why, going through the CFP study, the legacy planning reached out to me, estate planning as they called it, but it grabbed a hold of my heart. Just because at the end, when I'm done, here's what I want people to say. And I try to spend my life doing it so that people will say the things that I would want them to say in my absence. That may sound like a sick and convoluted thing to you, but it's just the way my mind functions. You know, it's like, what would people say about me doing this? And my grandfather passed away. My grandmother bought a mobile home and put it on my uncle's property. And that's very, very typical to do, by the way, if you're not from Delaware County. It's a very, very typical thing to do, and it all worked out real well. My dad had a sister that died at a very young age of 3 or 4 years old, older brother that had already passed away. So it was he and my other uncle were the sole survivors, the sole heirs, if you will. And Grandma bought the mobile home. That's all the money that they really had. This is before defined contributions really existed. So Grandpa had a pension. Grandma got part of that in Social Security. But she took all of the money from the sale of the house and put it in this mobile home. And she had told me and told my dad and my uncle that upon her demise, she wanted everything split between the two boys, my uncle and my father. And the bottom line is I saw the title. That's mobile homes have titles, not deeds. I saw the title, and it had Grandma's name and my uncle's name listed on it. And I looked at it, and I said, hey. You said you wanted everything to go to the two boys. This is going to go to just to my uncle. And she said, Joey, and please don't call me that, but she said, Joey, it's all in the will. It'll be taken care of. And that's really what kind of started my desire for people to understand how estate planning really works. What wills and trust mean? Which one of them do you need? And we can go right here from the very beginning. When I say that all beneficiaries are not created equal, my uncle had more assets than my father. There were challenges in the tax code from, because people will say, one of the major mutual fund companies has even said, very incorrectly, I might add, that you can fix it after death. No, you can't. Upon her demise, Uncle Tom inherited the asset. And then, based on his goodwill and nature, made gifts to my father, not quick enough to make my father happy, mind you, but did indeed make gifts to my father following the rules of the tax code. There were many variables that were involved that didn't need to be involved simply because people didn't understand the documents. But the tax treatment, as a grandmother, as a mom, she wanted her boys to be treated equally, and I get that. But from the IRS's perspective, they were anything but equal. And that's true in more families than not. In this case, we had a 55-year-old couple. They had 3 kids, one doing real well, one doing mediocre, and one we're not sure what they're doing. Right? I mean, and that's verbatim for the family. Right? You have 3 grandkids. 2 that appear to be hopefully all-stars in what you would want them to be. I have dreams of a grandchild being a golfer, right? We have dreams of what that is. One is clearly autistic. Don't tell me that they're all equal. They're equal in love, but they're not necessarily equal in need, and they're certainly not equal in the way that assets need to be delivered or distributed to them at some point in time of demise. Newsflash, ladies and gentlemen, you will die. So will I. And for us to ignore that is just irresponsible as financial planners. I have to look at you and understand you're on a financial journey. And if I've done my job right, that journey ends when something either happens to me or happens to you. I can't control when something happens to me, so I build a team. I build a process. I have 37 people that are there that are lockstep in line with what happens to you next in the event that I am not there. What I've yet to figure out is how to do that for my own family. If I, as the dad, the papa, if I'm not there, what happens, right? And so I've had to create documents to do the best of my ability to replace my job, my situation in terms of where I am. These kids are not equal. The asset distribution shouldn't be equal. For instance, go to the assets as they have them now, assuming mom and dad are going to die today simultaneously. You've got $1.65 million 50% of it's tax deferred in a 401k. That means somebody is going to pay taxes to get it out. Do you want that to be the kid that's doing real well, the kid that's mediocre, or the kid you're not sure what they're doing? Well, in all fairness, in this case, they said, hey, I don't want the kid I don't know what they're doing to have access to any of this money. I want somebody to be able to oversee it. The Financial Enhancement Group can do that for you. We are Trust Services Division. There's a reason why we do that, to be able to take care of people with special needs or special circumstances, as I like to call it in this case. Do I want that money to go to the family that's in mediocre income or moderate income? And the answer is, well, maybe. And the solution is there's 30% of the money is in the Roth IRA. It's money that's never going to be taxed. So I might make the person with the higher income the beneficiary of the Roths, and the people of the lower income or the moderate income, the beneficiaries of the 401k that is tax deferred. And you may be saying, well, but 30% is 30%. One's going to get the $200,000 is tax free. One's going to get $200,000 as tax deferred. I didn't say that. What I said was equal. And so we tend to, when we do the beneficiary work for people, we tend to net it out. We just had this happen. We lost somebody we've taken care of. It was at my wedding 34 years ago. So you can figure out how long I've been taking care of him. He passed away. We had the church as part of the beneficiary of the IRAs, not inside of the trust, inside of the IRAs. We had kids that got more of the Roth, less of the tax deferred, vice versa, some that got more of the money that was taxable. It is important to understand those tax ramifications in terms of how they work, right? So this is not, even though it says 1.65 million, doesn't mean each of the three kids should have, let's just call it $550,000 a piece right now. It can be distributed at different times. It can be taxed in different ways, and it can be different amounts if after the IRS is done, it is equal at that point. And that's really what we strive to do at the Financial Enhancement Group. When we look at that legacy planning, we want to work with your estate planning attorney to make sure that your documents are in the right place. My passion is helping you deal with you while you're still here and unable to make your own financial decisions. That's why we have a trust services division. That's why we focus really on that period of incapacitation. You're still here, but you need help making decisions. And then we're there for your family with the legacy portion to be able to kick in to help take care of those special needs and special circumstance issues. There's a lot to understanding the legacy plan, but when you look at this case, it is not as simple. And ladies and gentlemen, please, you did not work this hard. You did not save this long to make it this far and just think you can go to an attorney's office one time, check it off, and be done with it. Legacy planning is an ongoing thing. Call the Financial Enhancement Group, 800-928-4001.